Hey, this is Chris. Hope you're doing well, and welcome to Popcorn Finance, the show where we discuss finance and about the time it takes to make a bag of popcorn. And on top of this being a very special video version of the podcast I normally do, this is also an episode of UnPopped Kernels, which is a brand new episode format that I've added to the rotation. Normally, Popcorn Finance just comes out once a week, but I've been wanting to do more because there's just so many topics I want to cover, and it's just not normally enough time to fit it all in a very short once a week podcast episode. And so the whole concept and idea behind Unpopped Kernels is that, sometimes you make popcorn, especially like in the microwave, you throw the bag in there, you put in the time you think it's supposed to take to cook it, and you pull out the bag and there's like 100 unpopped kernels just sitting at the bottom. So what we're doing is we're going back into episodes maybe that I've done earlier in the week, and I'm reaching into that bag and I'm pulling out the kernels out of there, and we're going to heat them back up and pop those ideas or concepts that maybe we didn't get a chance to touch on during that episode. So some guests will come back and we'll kind of talk things out a little bit more. Or like in today's episode, I want to touch on something that I just haven't had time to discuss on the podcast. There just hasn't been a spot in the schedule for me to fit it in. So Unpopped Kernels is where it's going to live for now. It's been a really fun experiment testing out these new episode types. And today, what I want to talk to you about is interest rates and inflation and the impact all of this is having on us as individuals, because it all trickles down to us eventually in some way. And so I'm sure a lot of you have heard in the news now that interest rates are expected to rise. You probably have already seen interest rates rising in things like mortgages and auto loans and things like that. And so the first question you probably have is, why are interest rates changing at all? Like, why is this affecting me? What's going on? So to start things off, we need to first look at the Federal Reserve. So the Federal Reserve is in charge of the country's monetary policy. And this is really just a fancy way of saying they make sure that the economy continues to run smoothly. They make sure that inflation doesn't get too crazy. They make sure that unemployment isn't going wildly out of control, that banks have enough money to keep things flowing and this whole system doesn't just fall apart. And like I mentioned, one of their big tasks is inflation. And the way they monitor inflation and kind of keep things under control, especially when inflation starts to rise rapidly, as we've seen in the past year or so now, is that they can raise interest rates. So during their March 2022 meeting, the Fed, which is just a short way of referring to the Federal Reserve, they approved the first rate increase since December of 2018. And what they're increasing is something called the Fed fund rate. And this is a rate that the Fed sets that determines how much banks will charge each other in interest when they lend money back and forth to each other, because they do this all the time. And so when they adjust that rate, they're not changing it to like a specific percentage, but more so a target range. So they've been referring to the Fed fund rate as zero for a long time now, but really it was 0 to 0.25% or a quarter of a percent, because it kind of moves back and forth within that range. They've now increased it about a quarter of a percent. So it's gone from a range of 0 to 0.25 to a range of 0.25 to 0.5 or half a percent. And they're expecting to do 6 more increases throughout the rest of 2022 and several more into 2023. So you may be asking yourself, okay, the Fed's raising their interest rate. What does that mean for me? Are things going to get more expensive, like home loans and auto loans? And the answer, sadly, is yes. You've probably already seen rates increasing. Mortgage rates have actually gotten close to 5%, which is extremely high compared to where it's been over the past couple of years. I actually got a notification recently from my credit card. They sent me an email that said, hey, guess what? Surprise, your interest rate is going up as well. So as you can see, it kind of touches a lot of different areas. It's not a direct kind of like one-to-one change. The Fed fund rate doesn't necessarily directly impact mortgage rates, for example. Like the mortgage rate isn't the Fed fund rate. There are two separate rates from each other and they aren't directly tied, but oftentimes they move together with each other. So to illustrate kind of this relationship that exists between the Fed fund rate and mortgage rates, I wanted to show you this chart here. This is from the Federal Reserve of St. Louis, their website. And this chart here, you see it says Fred at the top. It always makes me laugh for some reason. I don't know, Fred is a random name, a random acronym that they've come up for this, but it's Federal Reserve Economic Data. And there's a lot of really interesting data on this site. And one chart here, it's comparing the Fed fund rate to 30-year fixed mortgage rates on average across the US. And so right here, I have a data point going back to, looks like we're starting at around 1981 here, and all the way out to 2021, basically, actually really March of 2022. And so here on the top, you can see in red, this is the average 30-year fixed rate mortgage rate. And then below that, you see the Fed fund rate. And they move in similar ways. You'll see that as the Fed fund rate spikes up, you'll see mortgage rates come up. As the Fed fund rate falls, you'll see mortgage rates fall. Now, as you can tell, the Fed fund rate is dropping at a much steeper decline than the mortgage rate. And also, when the Fed fund rate jumps up, the mortgage rates don't move as sharply. So that's why I say it's not a direct one-to-one movement. Like the rates aren't going up by the same percentage as each other. It's just more so the Fed fund rate influences all interest rates, and mortgage rates tend to move and shift along with that. So according to data from Freddie Mac, the average rate of a 30-year fixed mortgage has already begun to rise. It was up nearly 1% from 3.1% in December up to nearly 4% in early March. And now we've seen it hit around 4.7% at the end of March, right at the last week of March. And so what you're seeing is, even though the Fed fund rate has only moved 0.25%, it's barely even shifted, you're seeing mortgage rates climb much, much faster. And kind of what's going on here is that lenders are already pricing in those expected rate increases that the Federal Reserve said they're likely to I guess, implement, is a good word to use. They're likely to implement over the rest of this year and into next year. So basically, they're like, look, we know we're going to be able to charge more because we're going to be in a higher interest rate environment later in this year and into next year. So rather than slowly upping their rates, they're basically just pricing in all those increases right now and saying, well, look, if we're going to be locking people into these 30-year mortgages, we don't want to lock them in at this lower rate because one, they don't have to. And two, they're like, we know it's going up, so we're just going to capture that now. So basically, that's why you're seeing this such a sharp jump in mortgage rates, which, it won't lie, it sucks to see rates go that high. I don't own a home. I don't plan on buying one anytime soon, but it still does kind of suck to see rates jump up so significantly, especially for people out there. Like I have friends who are looking to buy a house, and I know it's becoming much more expensive every day as they're out there shopping around. So you may be wondering though, like we got all this bad news regarding interest rates, like everything's going up. So, hey, doesn't that mean that I'll at least be able to make some more money in my savings account? And I want to say yes, which is true. You probably will start to make a little bit more, but I wouldn't get excited at all about this because the thing is, Fed fund rate and savings interest rates, they historically don't really move at the same pace. Kind of that relationship I showed you between mortgages and the Fed fund rate. Let me bring that back up here for you. How when one goes up, when the Fed fund rate goes up, mortgage rates go up, not the same amount, but they do kind of move in tandem together here. If we go over and switch to this chart here, so this shows the Fed fund rate in blue and then the national rate on non-jumbo deposits. So that just means there's less than $100,000 in the savings account. And as you can see, it is almost impossible to notice the change in the interest rates paid in savings accounts. That's that red line here. You see, it's barely even shifting around at all. Whereas the Fed fund rate, we're seeing it have this huge kind of like hill built here. So this goes back to looks like October of 2014, and this is going out to February of 2021. Okay, so if you look back here, you can see the Fed fund rate is like somewhere around 0.1. It's barely even registered on this graph. The average savings rate was around 0.06%. That is, I mean, that's basically nothing that it's paying out. And as you see, we go from around 0.1-ish on the Fed fund rate all the way up here in April of 2019 to 2.42. But at the same time, we see that the average on savings accounts, it's at 0.1. So it went from around, what's this, 0.06 to 0.1. It barely moved at all, even though there's a pretty significant increase here in the Fed fund rate. So it just goes to show that really the Fed fund rate, it doesn't necessarily have a significant impact on the savings account interest rate you're going to see in most accounts. So when I went through and pulled some data, I went and looked back at like late March of 2022 of this year. And I found that the Fed fund rate was around 0.08%. So tiny, like nothing. Savings accounts were really nothing. They were at 0.01%. To put this into perspective, if you put $1,000 into one of those savings accounts, you would end up with 10 cents in interest over the course of the whole year. That's not 1 month. That's the entire year. That's all you would get. So basically it was zero. And if we compare that to March of 2019, the Fed fund rate was at 2.4%, 30 times higher than it was in March of 2022. while the savings account rate, or at least the average savings, was at 0.1%. That's 10 times higher than the average savings account rate in March of this year. So as you can see, the Fed fund rate was moving at about 3 times the rate of the average savings. So there's just another way of comparing and showing that they don't really move together, at least in a significant way. But the one exception was with high yield savings accounts. So high yield accounts, those would be typically accounts that you'll find online from banks that don't have a physical location, or if they do, they have very few physical locations. And high yield is just another way of saying like high interest, high return. And if we look back to 2019, you could find interest rates easily around 2% or more than 2%. And when you compare that at the same time to the national average for savings accounts, it was 0.1%. So it was already there. You see, there's a significant gap between what you would get at a traditional brick and mortar bank versus what you would get at some of these online high yield banks and their savings accounts. And now if we look at today, we're somewhere around 0.5% for those high yield accounts compared to the 0.01%. So the one bright spot in this is that if you do have your money, your emergency fund, for example, in one of these high yield accounts, which I recommend, that's what I do, you are more likely to see significant changes in your savings account interest rates, just because those rates typically have a much bigger range. We'll see them more impacted by this because they oftentimes will pass those increases in the amounts that they can charge onto consumers on the savings side as well. It's not a guarantee that's going to happen anytime soon. They won't necessarily just do it immediately with each Fed fund rate increase, but there's a chance they may. So I just want to give you this quick breakdown here of how we can all expect to see the interest rates that we see in our lives, whether it's on the borrowing side or the saving side, and how inflation and as a result, the reaction of the Federal Reserve by raising the reaction of raising interest rates, how that all will flow through and kind of ultimately end up impacting us. So yeah, that's what we're going to be doing here. I guess I'm going to be doing here. I'm the only one here. That's what I'm going to be doing here on these UnPopped Kernel episodes, kind of diving into some topics like this that maybe I've wanted to touch on, haven't had the time. And this is a great place for these type of conversations to go. And also, as you can tell, I'll be doing this in video format as well. Stay on the lookout. I'm going to try to keep this consistent. I'm scheduling myself to do these every week. So the main episode will just be in the podcast feed, audio only. And then these UnPopped Kernel episodes will be audio only, not only there'll be an audio on the podcast feed and they'll be in the video format here on YouTube. If you want to check out the podcast feed, you can just go to popcornfinance.com/listen. There's a link in the description where you can go check that out. I'd love to have you come join me on the podcast feed as well. And as always, if you have any questions, if you have any thoughts on what's going on with interest rates, inflation, leave a comment, or you can send me a message on Instagram. You can find me at Popcorn Finance Podcast. So as always, I appreciate you joining me here. Well, I guess this is the first time you've joined me here in video format. But if you've been joining me on the podcast, I appreciate you joining me again. I hope you have a great week, and I'll talk to you soon.